Taxes, everyone pays them, but billionaires seem to play by different rules. They're not breaking the law, they're using legal strategies built into the tax code. Today, we're pulling back the curtain on the top 10 ways the rich minimize taxes, and what you can learn from them. Ready to see how the game is really played? Let's dive in. The wealthy don't focus on earning a big salary or chasing the next paycheck. Instead, they understand that true financial power comes from building ownership, not just working for money. They know that relying solely on a paycheck keeps you trading your time for money, which limits your potential to grow wealth. They focus on acquiring assets, things like real estate, stocks, and businesses, that grow in value and generate income over time, even while they sleep. These assets can appreciate, pay dividends, or provide rental income, creating multiple streams of money that don't depend on daily effort. Income from a job is taxed at the highest rates, often leaving employees with less than they expect after taxes are taken out. This can make it difficult to get ahead, no matter how hard you work or how much you earn. But profits from investments like stocks or real estate are taxed much less, allowing owners to keep more of what they earn. This difference in tax treatment is a key reason why building wealth through ownership is so powerful. That's why investors often pay less tax than high-earning employees, even if both make the same amount of money. Ownership comes with unique advantages that employees simply don't get. The tax code is designed to reward those who own assets and invest, not just those who earn a paycheck. It encourages people to build and grow wealth through smart investments. So, shift your mindset. Real wealth isn't about how much you make at your job, or how high your salary is, but about how much you own, and how those assets work for you to build lasting wealth and financial freedom for your future. Real estate is a tax powerhouse for the wealthy, and one of the biggest reasons is something called depreciation, a unique tax benefit that most people overlook. Depreciation is a powerful tool that can transform the way investors approach their finances, and it's available to almost anyone who owns investment property. The IRS allows property owners to deduct a portion of their property's value every year, even if the property is actually increasing in market value. This means you can claim a loss on paper while your investment is growing in real life. It's almost like getting rewarded for simply owning real estate, regardless of how well the market is doing. This paper loss can dramatically reduce or even eliminate your taxable rental income, letting you keep more of your rental profits in your pocket, all while reporting little or no taxable profit to the IRS. Over time, this can add up to significant savings, especially for those with multiple properties. In some cases, these paper losses can even be used to offset other types of income, like your salary or business earnings, further lowering your overall tax bill. This flexibility is what makes depreciation such a valuable strategy for building wealth. That's the magic behind why savvy investors can collect rent, watch their properties appreciate, and still pay little to no tax, completely legally. By understanding and using depreciation, you can unlock one of the most effective tax advantages in real estate. Offshore accounts sound shady, but there are legal ways to use them. The ultra-wealthy set up companies or trusts in low-tax countries to defer or reduce taxes on global investments. U.S. citizens must still report worldwide income, but complex rules can allow for years of tax deferral. It's expensive and complicated, but for the rich, it's a powerful tool. Donating stock to a private foundation gives the wealthy a huge tax deduction, without selling and triggering capital gains tax. They keep control of the foundation, invest the assets, and only need to give away a small percentage each year. The rest grows tax-free, funding causes and building a legacy. It's philanthropy with major tax perks. Trusts are the go-to tool for passing wealth to the next generation, while dodging estate taxes. By moving assets into certain trusts, the rich remove them from their taxable estate, saving heirs millions. Trusts also protect assets from creditors and control how and when heirs get their inheritance. It's how fortunes stay in the family, not the taxman's hands. The rich structure their income as long-term capital gains, not salaries. Capital gains are taxed at much lower rates than ordinary income. CEOs often take tiny salaries and let their wealth grow through stock appreciation. They only pay tax when they sell, on their terms. Here's the jaw dropper: buy, borrow, die. The rich buy assets, borrow against them for cash, loans aren't taxed, and never sell. When they die, heirs inherit the assets at current value, erasing decades of capital gains tax. The estate pays off the loans, and the rest is tax-free inheritance. It's the ultimate way to live large and avoid taxes. The strategy: never sell, just borrow, then pass it on. Business owners turn everyday expenses into tax deductions. Travel, vehicles, home offices, even meals can be written off if used for business. Every legitimate deduction lowers taxable profit, slashing the tax bill. The wealthy structure their lives around their businesses to maximize these benefits. It's about making the tax code work for you. Where you live matters a lot. Moving from a high-tax state to a no-tax state can save millions, especially when selling a business or cashing out investments. Establishing residency takes effort, but the savings are huge. It's a simple move with a massive payoff. The wealthy control when they recognize income. They accelerate or delay income and deductions to take advantage of lower tax years. Retirement accounts and business sales are timed for maximum tax efficiency. It's all about planning ahead to pay less. These strategies aren't magic. They're about understanding the rules of money and how wealth is actually built over time. Anyone can start, no matter where you are right now. The key is to educate yourself, stay curious, and be willing to take small steps forward. Building wealth is a journey that begins with a single decision to take control of your financial future, and it's never too late to start. It's about thinking long-term, making consistent choices, and not getting discouraged by setbacks. Not all opportunities are accessible to everyone, but the core principles, investing, owning assets, and making your money work for you, are universal. Even small, regular actions can add up to big results over time, so don't underestimate the power of persistence and discipline. Smart timing, patience, and understanding how different types of income are taxed can make a huge difference. Start by learning the basics of taxes, investments, and how to grow your savings. The more you know, the more confident you'll feel making decisions that impact your financial well-being. Look for ways to shift from just earning a paycheck to actually owning assets, like stocks, real estate, or even a small business. Building wealth is a marathon, not a sprint, and every step counts. Celebrate your progress, no matter how small, and keep your eyes on your long-term goals. Remember, progress may be slow at first, but persistence pays off. If you found this helpful, like and subscribe for more tips and insights. Join the WealthVision community and take your first step today toward building lasting financial freedom. Your journey starts now. The future is in your hands. Make it count.